Hi, good evening, everyone. Thank you for joining us and thank you for being on time as well. So today we won't really wait for too long for everybody else to join. Let them join as and when they come because we have a lot of things to cover and we have very little time. And we have Srikanth with us, who's been, generous enough to take this session. So I'll give you a little brief background, Srikanth, about the audience here. And most of the startups that are here in our audience are from our Headstart hubs. And I've already told you a little bit about Headstart hubs. Headstart has partnered with the top innovation centers in the country, right from Sikkim to Bangalore to Rajasthan, Indore, and other states. So we're present across in 8 states with these Head Start hubs, and we cover different sectors within these hubs. So so that's just a little bit on that, and we'll again we'll run some polls to get a minute description of who are the audience today. So yeah, we'll do that. And for everybody who doesn't know Srikanth is a seasoned investment professional and a venture capitalist in the startup ecosystem with 10 years of experience. Currently, he's part of the leadership team at Qapita. Qapita is a fintech startup that works closely with startups in the space of equity management and shareholder management. Qapita seeks to digitalize equity ownership, unlock liquidity, and democratize value for all the stakeholders of the startup, including investors, promoters, and employees. So, like I said, Srikanth has a very deep understanding of the ecosystem and of the investment world as well. So we couldn't find a better person to host this workshop for us. So over to you, Srikanth. I know that you have a lot to cover, so I won't
Yeah,
take too much time.
yeah,
So
great. No, thanks a lot, Vanya. Thanks for the introduction as well, and good to be with the entrepreneurs. I'm assuming, and I'm seeing some known names as well. So I'm seeing that mostly entrepreneurs have joined. So it's always wonderful to spend time with them and learn from them more. So then share actually. But yeah, we'll try to, as I told Vanya, that this we'll try to make it more a co-creative kind of co-creation kind of a session and actually build something out. While 2 hours itself is quite short for a workshop, so I don't know whether to call it a session or a workshop, but we try to keep it in between. So we will try to keep engage more, and hopefully come out with some solid takeaways, and also some templates that I'll be using. I'm happy to share it with the with the audience if they find it useful. But thanks for that introduction. As Vanya mentioned, I am now with Qapita. I'm an ex-venture capitalist, I would say. I spent last 5 years working closely with founders and evaluating tons of financial models to maybe share some things that work, some things that don't work, kind of a thing. And that experience is what I'll try to bring. And also, like I said, building something from scratch. And I see that many of you might be early stage founders, so how we can kind of help you in your journey. And there might be various reasons why you might be looking at building a financial model. Of course, one is, every company needs to maintain its finances in order, but more so it is important for founders to have a hold of their financial projections and all of that for various reasons, including fundraising, even monitoring their operations on a monthly basis. And those are some of the things that I will talk about during this thing. So like I said, we'll keep it interactive. I have a few slides to set the context, and also we are taking big picture understanding to then really deep dive into the process of creating financial model. Initial time we'll use some slides for that, but maybe the middle portion of an hour we'll actually spend time on spreadsheet, because that's where the financial model work happens. So right, and then we can have Q&A all towards the end as well, and during the session as well. And I've also got a few Q&A from Vanya that was put in the Google form. So that was very helpful for me to kind of structure the presentation as well. So great. That's a bit of initial context. Yeah, and thanks, Vanya. So we also set up this poll. So Great. So 90% of you haven't raised funds. So that was something I was expecting in some sense, given the interest in the session. And good also to know that 2/3 of you are founders. Um, and few of you are already finance professionals, so I need to watch out for you guys. You guys may, and maybe you guys can contribute to the session as well, as we build it, right? Perfect. With that, let's get started. I Can I share the results with everyone? Yeah, I can also share the results with everyone. So yeah, everyone kind of sees who's there in the room. Great. And yes, the chat option is always open. So feel free to type in anything you want. I might react immediately or not based on the context and the discussion that's going on, but would love to keep it interactive and address or react to whatever you guys are thinking. So feel free to use that option. So with that, let me share my screen. So like I said, the structure is maybe roughly would like to take the initial half an hour to 40 minutes on talking about the nuts and bolts of finance. Again, like I said, we are talking about financial model, and within financial model, we are mainly talking of the cash flow model, right? Because that is what is the most critical thing that early stage startups need. If you understand the cash flow modeling, and of course the other things can be derived, the other larger financial statements, we'll definitely talk about it, so that you have the holistic understanding. But we'll actually create a cash flow model during the session. And I've also not thought through what exactly we'll do. So in the creation part, so I'll actually lean upon you guys to give me ideas on what to like what business model should we create the cash flow on and all of that. But we'll have a lot of concepts that we'll touch upon prior to that. So hopefully, it'll give you a good context to do this session. So yeah, that's let me just share my screen. Great. Thanks a lot. And just another thing before I start, because I'm just observing the chat as well. If you are the founder, and 2/3 of you are, so I know that. So if you want to just describe your startup in 6 to 7 words or one sentence, right? How would you do it? So just let me just get a sense of who all are there in the room. So and I know that many of you are early stage founders and have not been funded, but yeah, just describe your startup so that I know who you are and the startup, and it might help me give context during the Q&A session as well. So feel free to type in about your startup, and we can connect back on that. Meanwhile I will definitely start. But good to see some of the founders putting in, as I see. Yeah, and it also is a good way for you guys to network with each other. Some synergies might come up. Great. Thank you, Santosh, Anish, and everyone who's typing in. So yes, what's in store? So like I said, we'll understand the nuts and bolts of finance. When you say nuts and bolts of finance, we mainly talk about financial statements. This is something that most of the finance professionals, who are 20% of the people in the room, they deal with. And idea is to give you a bird's eye view on what that is, but not really deep dive into the whole bunch of it, because that is a separate workshop, full day workshop perhaps in itself. We'll talk more about the role of cash flows, and why cash flows are important, and everything with regard to monitoring your startup to raising funds. What investors look for, or what people need, is your cash flows projections or statements, right? And that's what we will focus on. We will also touch upon, to make the session more complete and give you a better perspective. uh, we will also focus on the what is investment, and what are the different instruments of investments, and what are the sources of investments. We'll again just breeze past it, will not double click on it. And then we'll actually link back to what was there in the description as well. So it's not just enough to have a financial model. You should be able to link it back to what you're going after. That's your business plan, that is your action plan, right? So financial model actually is not an activity in isolation. It's not like one day you just say, okay, let me do a financial model, right? It's all you're reacting to your intention of taking your business somewhere, right? And it might be a monitoring use case, it could be a fundraising use case, it could be as you expand, like I said, monitoring across business units and all of that. So there are various use cases in which you do it, and it's a hygiene, actually it's a discipline. Every startup should have a robust way to monitor their financials, and that's where the modeling part comes, which is mainly to project your financials, which is cash flows in this particular context. But we'll also touch upon a little bit on how do you analyze cash flows on an ongoing basis and do things like sensitivity analysis. There might be some questions on valuations. We'll not cover valuation in detail, but basically creating a robust financial model is also the first step towards creating a valuation model. Okay, so I'll just stop there in terms of the scope. But if you need more inputs on valuation, I can touch upon it a little bit, but we need a different session for that. So that's basically the scope. So link, the second portion is mainly to talk about how to go about your business plan. And I'm sure since many of you might be in the market raising funds, you might have created a pitch deck, you might have created your your note and all of that stuff. How do we take from that business plan to actually go link it to your financial model? And we have a simple template that I've created that takes you from your vision to execution, kind of a thing. So I'll spend some time on that. But the bulk of the time will actually go into back into the last piece, which is building the financial model. Uh, and within that, cash flow projections, like I said. So we'll also talk about why cash flow, why is it that important, and then how to build a model based on assumptions, based on the structuring it well, because ultimately it's not just getting the result out. Like it's not answering 1 plus 2 is equal to 3, and 3 is not the thing. It's all about how did you do that 1 plus 2. So a lot of cash flow is about assumptions and how did you structure the whole model than actually saying this is the what I need to raise money for, right? The devil is in the details, and that truly applies in the case of cash flow model. So that is what we will focus on. And then we'll spend some time on analyzing and something called sensitivity analysis, which I used to do as an investor, which I think you guys should also do as founders, which basically gives you a sense of, because nothing is certain in startup world, right? You might say you might unlock so much revenue from a particular product or a revenue stream, but you must always be prepared for a plan B, because the growth assumptions you assumed, or the various channel assumptions you assume might not be the case. For example, COVID might have disrupted every entrepreneur's business plan to some extent. So how do you actually prepare for the various situations is all about sensitivity analysis and running different scenarios, right? So that's basically the scope. And yes, I saw many of you have actually mentioned, some of you are working in smart cities and, edtech, healthcare, the fintech. So wonderful. I think a great diversity of, startups are there on this group. So very, very happy to have you all here. And I hope, you to take note of each other. So, you can always network offline as well as you see synergies. Great. With that, let's get started. Um, so yeah, like I said, the nuts and bolts of finance. Again, I'm not spending too much time here. Again, this itself is a session in itself where we're talking about financial statements. But I just wanted to demystify some very high level aspects about financial statements, because every time you talk of finance, you colloquially or interchangeably use balance sheet, P&L, cash flow, and all, right? But you need to really understand what they all mean. So yes, financial statements mainly, talk about three things. So one is obviously the balance sheet, which basically talks about the net worth of the company, and I'll talk a little more about it. So it talks about net worth, so your assets, how many, what are your assets. Then also it talks about your the source of the funding, so like liabilities, equity, and those aspects. I'll talk about it in the next slide. The next is the income statement, which is basically talks about profitability. So the revenue items, the expense items, and how on a periodic basis you talk about profitability, profit, loss. That is income statement. And the third vertical of the financial statement is the cash flows, which is what we'll also talk about today, which is basically reflecting the reality from a cash flow point of view, the inflows and the outflows into your business, and inflow into your business and outflow outside of your business, right? And that is the cash part. So I will talk about it. So very quickly, I'll cover balance sheet and income statement. So one is, so balance sheet is a snapshot, right? While income statement and cash flow projections are more periodic representation of data. Balance sheet always gives an as if basis, right? So it's like that. That's why you always see a balance sheet as of 31st March 2021, right? Which gives you what is your net worth as of the financial year end, right? While income statement and profit and loss, this profit and loss or cash flow statements are always spoken with a period in mind. So income statement for a particular period, which is 1st April 2020 to 31st March 2021, right? So if all the activities that have happened between that is in a way captured in the income statement, while balance sheet gives you a snapshot, right? So yes, like I said, it gives a sense of the net worth of the company. Again, if you're not if you don't know about it much, you might find it a little technical here, but one of the formula that typically people use in balance sheet is assets is equal to liabilities plus equity. So all the jokes and all the references that you've heard about balancing the balance sheet is all going back to this formula: assets is equal to liabilities plus equity. That means you whenever there's a transaction, there is anything happening in the company that impacts the net worth of the company, it needs to balance two aspects of it. One is on the asset side, and one either on the liability or equity side. For example, let's say somebody invests in your company, right? So cash is an asset, so cash increases, but you are also increasing the equity. So somebody is becoming a shareholder, let's say, in your company, and that money coming in is being represented under equity. So there's an ownership element. So cash increases and their ownership element increases, so that is the equity. So in a way, the balance sheet balances. Similarly, there is a liability, so somebody is giving you a loan, so again the cash increases, and you are liable to pay back that money, so that is recorded under the liability. So it is like the whom you're liable to pay, right? So that way your balance sheet again balances. Let's say you use the cash to buy another asset, so basically it is under the assets. So let's say you use the cash to buy capex, then maybe the cash component goes down, and the capex, like let's say it's a plant and machinery, so that might be a fixed asset, so that fixed asset will go up. So again, the balance sheet is balanced. I just took three examples to tell you how different transactions is enabling you to to view the balance sheet in totality and ensure that it is always balanced. And this is exactly what accountants and finance professionals do, who are the CFOs, or who are there in the company. Their end of year, they have to make sure all the transactions that have happened since the start of the financial year is kind of eventually being recorded accurately, and the balance sheet matches, right? um, uh, Feel free to ask questions here, but no, that's about thing. And there's also a concept of book value. Again, this is something to park in your head, not super critical from a fundraising or startup point of view, but there's a concept called book value. The book value is always assets minus liabilities. So this is typically known as a value that shareholders would get if company were to be liquidated. So your company is worth so much because they represent under assets. And then obviously, if you are liable to pay people like your debtors, right, money, your creditors, right, your people like who give you loan, or who you're like your payables basically. So they all need to be netted, and then that becomes your kind of value of your company if it were liquidated today. So it's just a sense of your value. This is different from the valuation of the company. So this is all based on your current, what is recorded in your books. But your real value of the company that an investor gives you on is actually on the future possibilities of your business. And that is where again the cash flow comes in, because cash flow talks about the future and not just what is there on the books today, right? um, so, what are categorized as assets for a software company? So yeah, I mean, so it depend. For there may be some nuances of a software company itself. For example, if you buy another software company, maybe you'll put it under assets, for some time as amortize the value of it over a period of time. But assets are typically like fixed assets and short-term assets. Your plant and machinery, your your furniture that you buy, anything that has a value over a period of time is an asset. That is the definition of asset. So if your software has a value as an in the future, then you categorize it an asset, right? There's a subtle difference between like asset and so when you buy something, you have an option to either put it under the balance sheet as an asset or expense it completely, right? Then it doesn't go into the balance sheet; it gets expensed out, right? So that the decision making that happens here is based on what is the future value of that transaction. So if you're buying house, of course it's giving me future value, so it's an asset, right, in the true sense, and hence it will be in your balance sheet, right? um, let's say I'm buying ink for my pen, right? Now that I just use it on this for this in this month, and it's gone, right? So it's an expense in some sense. So in a software company, Santosh, like, yeah, buying a laptop is an asset, right? Buying like I said, even buying IP from someone can be capitalized on your balance sheet. So these are all words that you typically hear. So when someone says, let me capitalize this transaction, which means let me take it to the balance sheet. Why? Because I am seeing future value of that transaction, like it's a property, or it's a product or something like that. So let me put it on the balance sheet, and I will have ways in which I will expense it out over a period of time. That exactly is what is called as depreciation or amortization. I'm again going a little technical here, but that is a process where you take an asset and then over a period of time expense it in your P&L. And I've not yet talked about P&L. um, that is where you expense it out, so the asset of the company. So it's like every asset typically has a life, like your laptop has 5 years, you typically depreciate it over 5 years. Your house, you might depreciate it over 20 years, and things like that. So yes, Pratik adds that exactly. Patents, again, why? It's a future value, right? So anything that has future value can be classified as that is an intangible asset where you can't touch it, but definitely it is giving you value in some sense, right? So that's about assets. Assets is like I said, liabilities plus equity. This magic formula. So every transaction, you should be able to balance this. If you're not able to do it, maybe you're doing something wrong. That is the that is the summary of it, basically, right? Like I just took 2 3 examples. Let's say Santosh is buying good question. If we buy goods on EMI, is it an asset? Very good question. So when you actually so the thing is, your EMI is actually becoming like liability. You're liable to pay over a period of time. um, but so the question is whether you are buying it as an EMI. Again, I'm not a finance accountant here, but if you are buying it on, if you are taking the possession of it under your company, then it definitely becomes an asset, right? Because you own the product, but also means that there are liabilities for you to pay in the future. So it balances it that way. But if you're buying it on a rental basis, then it doesn't become an asset, because the ownership doesn't lie with you, and you will basically it is a completely in the P&L zone where you pay. It's an operational expense that you're paying, and you're using the services for that duration of the rental period, right? So those are some nuances around it. Second, income statement of P&L. So this is, like I said, this balance sheet is always at a snapshot, right? While income statement P&L is for a period, and it is basically a statement of profitability. And simply said, it is a statement of income and expenses, right? But one major difference here is there is a concept called accrual basis, right? So the income and expenses are on an accrual basis. Now, for example, I make a sale to a customer, right? Let's say I am selling software, right? So I'm making a sale. I raise an invoice today. I have already delivered the software to the customer, and I'm raising an invoice. So this is where I'm already realizing that income, because we have agreed to transact. I have delivered the goods, that is software, and I'm raising an invoice. It's typical world that you all relate to, right? So here I have already realizing the income today. Let us say today is 12th July or whatever. But maybe the actual cash flow is coming in a month from now, because I'm giving that period of leeway to the customer to pay me, right? So here the under the income statement, I'm realizing the income as of 12th July or the date today. And In the cash flow is when we actually realize it when the actual cash comes in, right? So this difference is basically the accrual basis. So I'm accruing that P&L profit income much in advance before even I make the thing, because at the end of the day, the customer is supposed to, is liable to pay, he or she, right? So in this case, it is realized as a income, and it goes and sits under something called as receivables, which again is a balance sheet item. The receivables comes under assets, because as a company you are liable, or you're liable to receive that money from your customer, right? So that's the difference with regard to, that's what P&L is. I'll talk about cash flow, and that's where the difference comes out very, very clearly. And or P&L also includes sometimes the non-cash items like the depreciation, amortization. For example, we just discussed, you bought a laptop for, let's say, 1 lakh, right? And the lifetime of the laptop is 5 years, right? So every year you are actually, and if you are doing something called a straight line method, then 1 lakh divided by 5, 20,000 rupees every year, you are depreciating it or amortizing it, that asset, right? So every year you are, so on day one, you spent 1 lakh, but you're not realizing that as a loss. You're treating it as an asset. This is exactly what I said. You're capitalizing that asset, right? And then every year you're basically realizing 20,000, right? Why do you do this? Anyone wants to take a guess? Why do you even get into depreciation or amortization? This just complicates our life, right? But why do you think it makes sense to, not recognize that whole laptop 1 lakh as a cost or expense on year one, but you rather go for a depreciation? Anyone wants to take a guess here? And you can use the chat, right? Feel free, so that I also get a sense that you are picking it up, right?
Because that has got a life, and it will be there for a few years.
Exactly. So
Yes,
Sanjay,
sir.
yeah, so Sanjay is right, that that has a life. So it is unfair that just in year one, okay, somebody also, Havani actually mentioned it has been taxation. So it is unfair that only in year one I take all the expenses, right? Because I'm getting value out of that asset over a period. I'm using that software to code, and that engineering team is delivering product, and it is giving revenue, so much revenue in the next 5 years, 10 years. Why should I, expense everything in the first year, right? So this basically helps smoothening your profit and loss. So it's not like in that regard, right? If a steel plant would have expensed all its asset, then it would have been loss making the first year, like in tens of thousands of crores, right? So it's basically helping you smoothen the effect of your profitability, so that and also correlate it with your revenue in some sense, right? Because you are using that asset to generate the revenue in the first place, right? So that's why it seems complicated, but it's very, very logical in that sense, right? And hence many assets, let's say anything that has a future value, you can actually capitalize it on your books. There are definitely a lot of norms. Again, I'm not the expert in which category to capitalize for what period and all of that, but there are definitely norms, and there are good practices that typically chartered accountants deal with, right? And I'll stop there. I'll not get too much into the details of this, okay? um, uh, so yes, that's quickly about balance sheet and income statement. But we will today talk mostly about cash flows, okay? Because this is the most easiest to understand, right? It's very intuitive to understand, unlike balance sheet and income statement, because there's always a bit of you can be really smart about it. You can engineer things. Like I said, all of this you can play around with the depreciation schedules. You can realize something, you can take a lot of discretion at places and all of that, right? But cash flow is very, very straightforward. It is basically your inflow and outflow, right? And thankfully, it's cash at the end of the day, so it's your reality. It's there are various ways in which we monitor and you record cash flows. Again, if you go to any publicly listed company, you will see these aspects, like cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. These are basically categories of bucketing those various inflows and outflows items. In a typical finance world, people start with the profit and loss statement and then create the cash flow. It is little counterintuitive, at least for me. We will actually use a completely different model. We'll use a first principles approach to arrive at cash flow. But a typical chartered accountant might start to create the balance sheet, create the P&L, and then create the cash flow from the income statement. So they start with the net income, and then they make all the non-cash adjustments. So just now because depreciation is not really a transaction, right? We are realizing it's kind of intangible or virtual at the end of the day. You made the transaction in first year itself, and then you are recognizing the expense over a period of time. So it's not a real transaction per se. Whereas cash flow will only look at the real transactions, wherever the money has come in or the money has gone out, right? And that's why in P&L, since you have made all those adjustments with regard to depreciation or receivables, payables, the example that we just took, or tax liabilities that you might have, they all need to be readjusted back to actually. So you actually did something and you're undoing something to create the cash flow. But that's what I said. It's a little counterintuitive. There are some, good videos actually you can go through if you are really interested to create your cash flow basis that method. But what we'll be focusing on is in the other two parts, which is more direct or the simplified cash flow method, which is the template I will show with you just now. Okay. Direct method is again under the same heads. The difference is here you go by the actual entries on the bank statement, right? So it is a more intuitive method, like I said. So here you, like I said, you do the P&L and you undo it to make the cash flow. And that's how you make the operating cash flow. Investing cash flow is basically all the investing activities. So all the capex or all the investments that you have done with your cash, which will give you future benefits, which has basically been in your balance sheet. And financing, so this is mostly all the activities that has increased your assets in some sense. And these are all the assets, all the activities that has increased your liabilities or equity in some sense, because they are financing your company. So it could be a bank loan or it could be equity investment, and all of that, they are cash flows from financing activities. So operating, self-explanatory. So any operating activity with regard to sale of goods, expenses, cost of goods sold, all of these are under operating. And also you're adjusting the depreciation, payables, receivables, and all. Investing is anything that you are creating an asset, so it's impacting the asset in a positive sense. And financing activity is bringing in money into the business, in some sense, through financing activities like raising a loan or raising an investment, etc., which is either increasing your liability or increasing your equity, right? So these are all the various buckets of the cash flow statement, right? Like I said, in direct method, you still go ahead and use these statements, but instead of going this indirect method of starting with the P&L or the income statement and then generating the cash flow by adjusting these things, you just go for a more intuitive way. You take every line item that is in your bank statement, like, okay, I purchased laptop, so it's an outflow, right? But there's an asset increase, but from a cash flow point of view, I'm losing money, right? Let's say the customer paid me, that is an inflow, right? So all of this will go into the operating activity. Let's say maybe the laptop will go into investing because it is increasing the assets, right? So things like that you can kind of structure into the thing. Simplified cash flow, which is what I will show you, is relevant for startups and investors. So you don't get into these broad buckets of operating, investing, financing. Rather, you define your own categories, like revenue from various segments like geography or category, product lines, and all of that. And that is inflow, right? And outflow could be salaries, and you can bucket it. Basically, there's a lot of flexibility that the simplified cash flow method will give you. And that's also the way in which your investor might appreciate seeing these kind of financial models. So a simplified cash flow is, as the name indicates, it's a simple statement of inflows and outflows month on month. So we take it on a month on month basis, while these are more like I said, an annual period, right? Whereas these is a month on month basis. Simply put, a simplified cash flow should ideally reflect your bank statement, right? If there's some entry on your bank statement, it should also be, hitting your cash flow statement in some sense. This is for ideally for early stage startups with, limited inflow outflow, because the moment you are getting into, like, you become a large e-commerce and all of that, you will have to like do a lot of bucketing and, things like that. That's where you have your finance team and CFO team. For an early stage, you can create a simple spreadsheet and maintain it. And I will show you that during the creation session. And yes, these are all at your discretion. How do you want to bucket it? What makes sense? How do you want to monitor your expense? Which are the ratios you want to look at? All of them is left to you, because at the end of the day, it's all manageable and it's a simple model, right? So this is a quick intro about cash flows and cash flow statement. Any questions? Feel free to kind of jump in. So I have a question, by the way, for you guys. So given that I did a quick breezer, because obviously there's paucity of time, so I can't go deeper into each aspect. But can a startup have a negative cash flow but yet be profitable? Anyone? Do you want to type in? Okay. Hey Varun, you- uh, can you just describe it a bit?
Yeah, I believe. Hi, Srikanth.
Hey.
Hope you're doing well.
Yes.
So, let's say a startup, which is there for about 3 years, let's say. So, if you look at their, cash flow over those 3 years, you can, over over that 3 year period, because let's say the first second year was actually negative cash flow. So that is continuing, and even in the third year, that profit that you have made is not enough for the accrued negative cash flow that you have had in the first and second year. I mean, I can use the same example for the future cash flow as well. I mean,
Right.
right. So in that given year, I can be profitable, but because of I'm looking at it in a cumulative manner over 2, 3, 4, 5 years.
Right.
Yeah.
Correct. So exactly. So even like this also goes back to the first example I gave, right? For example, if I were to build a steel plant, right, I would incur, let's say 20,000 crores. That is a huge negative cash flow, right? In the sense, assuming that I have the money in the bank before the financial year, I had financed it last year, but I'm incurring that negative cash flow expense of setting up the steel plant. But as we just discussed, all of that is getting capitalized. So I can still end the year in a profitable. I can still generate revenues for my steel plant and the steel, and be profitable, right? So that's something that you should like. I hope you appreciate that point, right? So basically, here the negative cash flow is because I'm incurring a lot of expense or outflow. I'll not call it an expense, because expense is in the profit and loss world. I'm incurring a lot of outflow because I'm buying a lot of assets, but I'm capitalizing all the assets. I'm not showing it as a loss or an expense, but I will use 10 years, 20 years to show and amortize it. But by the way, I'm already selling steel that same year, and I'm making, let's say, 100 crores as profit, right? So I'm profitable, but I have a negative cash flow, right? And then I asked this question because this is the way it is represented in the books, right? And you should appreciate that at all times. Um, Okay, that was the first question. I hope it makes sense. If there are any questions on that, feel free to ask. So let's flip it around. So can a startup be loss making and yet have a positive cash flow? Like it's making a loss but has a positive cash flow. Okay, anyone wants to take a shot?
You can have external investments coming into the business while you're still loss making.
Perfect. Perfect. Exactly. So in fact, a lot of our unicorn funded startups are all into this category. If you look at P&L statements of there are a lot of firms that give out, because all of them are filed under MCA. So you can go to any company and get their MCA statement, like their audited statements. You can see that they might be marginally loss making, or sometimes a lot loss making as well. So all of them are positive cash flow because they're all sitting, last 6 months, there have been 30 unicorns or whatever. There are 60 unicorns, but there are some, I think, 18 unicorns in this year. All of them have got hundreds of millions of investment this year, and everyone is sitting on a positive cash flow in that sense, right? It's in their bank, but many of them might actually be loss making today, right? I hope that again is clear to many of you, right? Feel free to ask questions. So yes, now coming to know why is cash flow important, right? um, so like I said, no, cash is the ultimate truth, right? You can't, so like I mentioned, your balance sheets and P&Ls can be engineered, right? Like it can be the way you depreciate, the way you realize, the tax liability part and deferred tax liability. There are so many line items where there can be some discretion, or here and there you can make assumptions. You can capitalize something, assuming arguing that they have a future value, and so many things you can basically do, right? But cash flow will never lie, right? So if something is in your bank statement, it is inflow. Something is going out of your bank statement, outflow. So it's very, it's very objective in that sense. It's very white or black. Cash is king. The startups fail more because of cash flow issues than actually whether the business model is profitable or not, right? Because if business model is not profitable, you can always pivot and do something, and you can only do it if you have cash in the bank, right? And all of your entrepreneurs, many of you might be living, have lived a foot to mouth, hand to mouth existence in some sense, and you know it best, right? That cash is king, and and hence monitoring it and having the discipline around it is the most critical, right? And hence at all times, ensure visibility of 6 months of cash flow. That is one of the takeaways from today's session, that as you build a cash flow, how do you ensure visibility of 6 months at all times with a good degree of confidence? Because what you're doing in next quarter, what you're doing in next 6 months, unless a situation like COVID hits, right? Things are still under control, right? You're hiring or not hiring, you will get some revenue or not, right? There's a little bit of confidence. If there's not that much confidence is not there, then you are in a very volatile business in some sense, right? And I'm not saying it can't be possible. Of course, if you're starting something very new, there's so much uncertainty around it, but definitely have an assumption or have a confidence level of what the next 6 months looks like for you, because it's very extremely important for you to project it and plan for it, right? And also and then ensure that you have the runway for it, right? And runway could be just money in the bank today, or a certainty that you will have a series of revenue inflows coming in, which will make you survive if you are living in that service mode existence, that every month you get money and you give out money, right? That's the hand to mouth existence. Or you are confident that you might get an emergency loan from someone, or you will be able to raise funds from an investor, right? These are all various ways in which you can get money into your organization, and the outflow, basically the burn for the next 6 months, gives you the projected outflow of the organization. So it's very, very important for early stage founders to have that discipline and monitoring mechanism to take stock of it at all times. Again, the template that I will use will be a good resource for all of you, and I can definitely share that. Any questions? Great. So very quickly, I'll cover, again, this is not part of the pure play financial modeling, but I just wanted to tell you that every time you talk about raising money or fundraising, typically you just say, okay, it is one kind of investment, but there can be many different sources, and I just wanted to talk about that a bit, and also the instruments, right? So first of all, why do you need investment? Like there are many bootstrapped companies here. You have not, like, I think 60 many of you have not yet raised funding. So very quick, you can use the chat. Why do you need investments typically? Assuming many of you are looking to raise funds, right? What are the 2-3 things to scale? Okay, scale is quite a broad word, but obviously that means you need to have the capacity to scale. So you need to have team, go to marketing, spend on marketing expense, market capture. Okay, so in an ideal situation, guys, what should fund all of these expenses? Okay, R&D, very good. But let's say marketing. What should fund marketing? Do you think investor money should spend marketing? Customers, very good, right? So okay, to manage the cash flow. So Varun is very right and correct that to manage cash flow, still the time is sustained. But yes, on a equilibrium basis, when you hit equilibrium, right, your customer should marketing, your customers' revenue should fund your cost of acquiring the customer, like CAC as you call it, or so the salesperson's cost. If revenue is not funding the salesperson cost, then what is that person selling at the end of the day, right? But of course, when you start your business on day one, you don't have the revenues, right? It takes some time for you to hit those revenue numbers to an extent till which it is a different matter that in a heavy liquid heavy country now like India, you can remain not having that much revenue for an extended period of time because there are investors who are willing to put faith in you. For example, a Flipkart took 10 years and yet it's still burning more because there is investor money coming in anyway, right? But yes, in an ideal situation, the revenue, but all of these are very valid things. Typically, you want to have a thumb rule that equity funding, right, needs to come into very high leverage, go after high leverage opportunities, right, where you are able to get it funded from some investor, because you know that tomorrow you can unlock a lot of value from it tomorrow, right? But some of the other aspects should ideally be funded from other sources. For example, any sales, like sales commission, marketing cost, all of them should ideally come from revenue, because if you're not able to make up that in the revenue, then your strategy is wrong in some sense, right? So I just wanted to park that thought. Of course, early days, everyone gets all the expenses come out from equity investment itself, but keep that thought in mind, and that's why it's very important for you to seek the right source of capital. It could be grants, it could be equity, it could be debt. All of them are available at your disposal. These are some indicative list, again, keeping an impact lens, but you can extrapolate these names to any category of sources. So, and also the stage of the startup. So in an early days, obviously you don't have revenue. So who will fund your innovation or R&D, right? It could be grants. There are many grants in this country, government schemes, philanthropic grants, etc. It's available. So you definitely should look at those opportunities. F&F is friends and family. Sorry for the jargon, but like even early days, who supports you? Your friends and family support you, right? So in that sense. Then as you scale, more and more liability based funding comes in. So one is equity is also liable to pay back, but not as a compulsory EMI kind of a thing, but eventually that person has a share in your company, so that person obviously is looking at a much larger return from that investment. So these kind of returnable kind of capital, right, equity, debt, these things become more prominent. Of course, there is grants also available. And so you need to know that apart from customer revenue, which actually is the holy grail, everyone should eventually aspire that everyone invests in your company, because tomorrow you will become profitable, and all of your expenses, including bonuses, dividends, etc., will come from the revenue itself. That is what is happening in a TCS. That is what is happening in Infosys, right? Because they are all profitable companies. But till the time you are in that venture mode, right? You're building a venture till the time you hit that profitability, you need these sources of capital to manage your cash flows, right? And that is the larger perspective that you all should take away today, right? So it could be grants, equity, debt. Obviously the holy grail is going to the customer revenue, and there are various sources, and you should definitely explore all of these sources, right? And then there are various instruments, like I said. So equity, and this is like literally it's rainy season, both from monsoon point of view as well as equity funding in this country. Every day is like so much news and so much foreign capital as well coming in. But yes, you need to be wary. You should not be obviously diluting a lot as well. So there are various forms of equity and equity linked instrument. Again, this is just a slide I had, and I thought I'll just share it. I'll not go into the depth of this, but it's also the most expensive form of capital, as you're giving away your share. So be doubly careful in raising equity money. Like I said, raise it for very high leverage items like product development. It gives you non-linear impact, right? You develop a good product, it will fund you forever, right? If you develop a good software, it has a non-linear impact, right? But let's say an operating cost, like say hiring your salesperson or getting working capital for your product, right? Your business. You need to really think whether you need to spend equity for it. Of course, if you don't have any choice, then becomes the last resort kind of a thing. But always look at diversifying fundraise in other non-expensive form of capital like debt, instead of putting all the eggs in equities basket in some sense, right? So that is just a point. Again, feel free to ask any questions in this, but that's something that you keep in mind. Debt, again, not a lot of startups frankly get debt. So in a way, me telling you that, hey, explore debt, and all of that is good to hear, but maybe sometimes not practical, because not a lot of banks line up to give debt to startups. But understand that everyone needs certainty of cash flow, right? A bank will just not give money because you're too risky. So as you hit certain predictability of cash flows, you have existed for 2-3 years, you are making good turnover and all of that, maybe the banks will be interested. There are so many schemes like all those mudra scheme, etc., which are supposed to give debt to startups. So wherever you think that and like I said, debt is a double-edged sword. So only if you can manage the cash flows, you should take it. Otherwise, it might be a very bad form of capital raise for you, because if you default, then it might just lead to several repercussions for both the company as well as the founders. So raise debt only if you can repay it, and there are obviously various sources. And then grants, again, very interesting form of capital. Increasingly, you are seeing a lot of promotion of grants by governments and all of that. So do keep an eye. This is like your bonus. So if you get it, just don't waste it, and just use it for, again, very, very new initiatives and experiments. And the reason I wanted to talk about is, at the end of the day, you have to manage your finances, and you need to know what are all the options available to you, because eventually these are the things that will get into your cash flow. So this was a slight detour we took on the sources of capital. Again, happy to take any questions so far. So we are, I'm just looking at the time. So we are at roughly 4:50. So let's hit actually the main part. Okay. Great. So the way we will go about the financial modeling is, like I said, even in the description, is it's really a matter of aligning your business plan to your financial model, right? Otherwise, if you do these exercises in isolation, it doesn't make any sense, right? And we also have a template where we can do it in a more structured way, so that tomorrow you want to revisit your model with other assumptions of your business plan, then you should be able to do it very easily. It should not be like, it's a re-exercise of everything. So that's why we have created a template which takes you, aligns your startup's vision to your execution, which is what is the GTM plan, as I call it. It can also be called a action-oriented business. It's nothing but a business plan, but in a more action-oriented way, because your financial model, in a way represents action at the end of the day, because you are, there's revenue, there's cost, which means there are activities happening in your business, right? So GTM plan is an action-oriented business plan. This is, how it talks about your blueprint to reach your customer and, sell your value proposition. It links your vision, strategy, execution to your cash flow or your financial model. And it's not a one-time exercise. It's a continuous and an iterative exercise. It's also both retrospective at one side and forward looking at the other, right? So you should be retrospective to see how you have achieved things that you wish to achieve and what you have not achieved, and be able to look at the future with that objectivity, right? You also, you don't want to be living in an illusion that you will achieve something that you have not achieved in the past. So it should always be iterative in that sense and reflect the true reality as of today. At the end of the day, another thing I want to mention, of course, you might give a plan to your investors and all of that, but at the end of the day, you should have your plan. This is your plan. And that's why it's very important for you to be realistic and truthful in the plan that, let's say, we will create now. And it also is a clear understanding of your action plan, right? Like I keep telling this to founders, right? Creating a financial model should actually be a very mechanical exercise. That's because you would have clarified a lot of those things that would go into assumptions in your financial model already, because they are all part of your action plan, which is coming from your business plan. If you're sitting on your financial model and doing a lot of brainstorming on the Excel, then Excel becomes too complicated. The spreadsheet becomes too complicated. So keep that clarity and brainstorm it in your team. Put it out in a structured plan, and that will basically inform or advise how to model your financial model, right? And that is exactly what we will cover in subsequent slide. And so this is the GTM template that I'll cover, and we'll spend most time on the last step. Actually, I'll not spend any time on most of these things, because many of these things are quite standardized from the industry. So I've not looked at reinventing the wheel, rather taking the good things that work in the ecosystem and stitching it all together to make your cohesive plan, right? And this is your action-oriented business plan, or the GTM template, right? Which aligns the vision, which aligns your larger purpose of your organization to your this month's cash flow, right? And they are all should be in sync, because that's the whole you're executing this month and next month, the next 6 months, because you have to realize the larger 5-year vision of your company, right? And why you came together in the first place. So we look at the vision, mission, purpose, just about articulating it, right? Then you all must have come through this business model canvas, which you all can. I'm sure you have come across it, and I'll not spend time on that today. But that's a good kind of understanding of your business strategy from a 2 to 5 year point of view of where you wish to go, what is the value proposition you want to create, who are your customers and all of that. Then we get into the zone of execution. So until now it was vision and strategy. Now we get into the zone of execution. One of the very nice frameworks that I have been quite interested in and implemented it in some of the startups that I've worked with is the OKRs, objectives and key results. Again, it's a framework made famous by Intel, Google, and likes of all of Silicon Valley tech companies, and now actively being used in India-based tech startups as well. Something, lot of material is out there for you to look at it, and these are just simple way in which you can manage and monitor your objectives and key results. Meaning, what are your objectives and what are the ways you measure that you are successful or not in achieving those objectives, right? A very nice way of keeping yourself to the ground and ensuring you are hitting those objectives. So this will set the goalposts for your business, and this will basically create the game plan for your business, right? So if you're clear about these things, then creating the financial model, like I said, is a formality, right? Because you exactly know what you have to do to hit the revenue numbers. Do you have to hire people? Do I have to spend on marketing? So all those decisions are already made here, and it's just a matter of putting those assumptions now into your financial model to get your version of your financial model for your company, right? And for that, we have certain templates that we use. I mean, this was a lot of it is something I developed in my previous experience at Social Alpha. So like, I used to, use a needs assessment, but things like product strategy, which basically every company will have a value proposition. So what is your strategy for that value proposition, right? How are you developing it? How are you, building on top of it, expanding it and all of that. Same thing with your sales, because at the end of the day, like Steve Jobs mentioned, right, there are two important people in a startup, the people who can code and people who can sell the code, right? So in a way, the product person and the sales person are the two most important people who are existential to the business. Everyone else is actually playing a supporting role. So these are the two important things that every CEO should always keep cognizance of: the pipeline, the roadmap of the product and all of that, right? And another important thing is the cash flows, which is where the modeling piece comes in, right? So this I have found a lot of startups find it useful of putting it all in a cohesive way like this. So I just thought I will share that with you. Any questions so far before we actually get into the modeling part? Does it make sense? And I will actually show you the template. So, that it's all actually in a spreadsheet itself. The way I recommend is everyone is to do it on like a Google spreadsheet, so everyone can co-create it. And that actually is not a one-time exercise. It will, you keep coming back to that template. Any questions so far? Great. Okay, so let me now go to the next. So this is basically the crux of what we wanted to discuss today, right? Yes, I will share this templates and the PPT as well. Yeah, I'll share it. You can always connect with me, but I'll also share it with the organizers. So what is a cash flow model? So like I said, simple. It's detailing the company's inflow and outflow. A cash flow, many times cash flow model can also represent the data of the past period. So these are actuals. Again, no ambiguity. This should reflect your bank statement. Data for future periods are the projections, which is where we'll spend a lot of time today. And it should reflect the strategy and the action plan that we discussed in the previous kind of things, right? So the art of creating a cash flow or the financial model is starting from assumptions, the same assumptions that that is resultant of your action plan. For example, your action plan says you need to hire, say, the sales function of, then your assumption is you will be hiring those salespeople, so you have to include them in your projections, to make it, because you will start incurring those expenses as soon as you hire them, right? So all the assumptions go into a staging area. Staging is like that, the dress rehearsal kind of an area, right? Where you prepare information and all of that. And ultimately you put it under the monthly projection. These are different sheets, basically. I will talk to you about it. So we start with the monthly projections because, like I said, things are more certain in the near term. Like I'm sure, let's say an Anish or a Santosh or a Varun, you know exactly what is happening next month in your organization, right? I mean, at least that is the least anyone can expect. Let's say there might be very less uncertainty from, okay, what will happen in July end, right? But as you go, okay, what will happen in September and December end, I might not. I mean, there will be a certain amount of, uncertainty there. But my idea is at least next 6 months, you should have a very clear understanding of what your business is, how your business is going. So start with monthly projections to a reasonable time frame. It can be 12 months typically, or 24 months, and then you annualize it, right? Because then it's all about your growth, and then you link it with your larger vision, right? You want to hit 5 year, you have to hit this number. But incrementally, if you're not even hitting like 10% of it, then somewhere, you might start questioning whether your large number is, something imaginative, right? So at the end of the day, both ends should meet, right? Your incremental monthly numbers should add up to the larger picture, and the larger picture should be able to be, cut down into achievable smaller targets. So this exercise actually helps you achieve that whole, trajectory, right? So that's why you create a monthly projections for some time, and then you annualize it and create the annual summary. This is where this is what your investors will be interested in. So they to know, okay, somebody asks you to include your financial projections in your pitch deck, then maybe you will include annual summary of, how your company will become like 1,000 crore company in the next 5 years, because maybe that is the kind of numbers a typical venture capital is interested in, or expecting to invest in you, right? And then there are things like sensitivity analysis. I'll touch upon that a bit. Again, not super critical from a founder point of view, but you need to know that exactly. For example, there would never have been a sensitivity analysis for COVID, maybe standing in Jan 2020. But you need to know that when things go bad, what happens, how can you be prepared for it, what are the plan B, plan C scenarios, kind of a thing. And then basically the annual summaries will also give you something called free cash flow. And free cash flow is basically the starting point of going into valuations, right? Because your valuation is basically generated from the free cash flow, which is basically the net cash flow that is, negating all the inflow minus outflow, is the free cash flow. And the more the free cash flow, the more valuable your company is, right? And that's where your value of the company. And in the venture investing, most early stage companies will have a negative free cash flow, but because there's a possibility of a very large future cash flow that you can accrue, is why venture capital or any investor want to invest in you, because they believe, let me invest in this company today, because this company will generate a lot of returns tomorrow, that it might become super attractive for a new category of investors, and that is where I will want to exit, right? So those are the aspects around the free cash flow. Very quickly, before we get into the Excel mode, some inflow line items that you need to know. It can be all kinds of inflows, all kinds of revenue recognitions, right? Sale of goods, subscriptions, commissions, service fees, license fee, brokerage, or any kind of realization of income is in your inflow, basically, right? If the promoter is putting in money, many a times when you bootstrap, obviously you're putting paid up capital in your company, plus even beyond that, you might put equity, or you might have promoters debt or directors loan. All of those are inflows, basically, right? So any kind of loan is an inflow. Any kind of an equity investment by an investor is an inflow, right? And any other cash injection, let's say you won a grant, you won an innovation grant from government of Karnataka, so that is an inflow, right? So recognizing all inflow items, right, and recognizing all outflow items, very simple world at the end of the day, right? And outflows could be all kinds of expenses. So it could be cost of goods sold, like which are direct expenses to realize the sale. Like if I were to sell you a pen, then I have cost to produce that pen, right? So that's cost of goods sold. Other variable costs, like let's say I'm giving a commission to the person who's actually selling you the pen, so that is like a variable cost, because it varies with the unit of sale, right? Every incremental unit I sell, I am incurring cost, so that is a variable cost, right? Or the most important things in startups is the salaries and the people cost, right? They are the most expensive these days, as well as the most value creative entities or expense items in your business, because they are the ones who will make or break a business in some sense. Then of course, other aspects, contracts, consultants, any infrastructure, utilities, these are like fixed costs in some sense. SG&A, sales, general and administrative expenses, R&D costs, which are somebody also mentioned, like many of you might realize the expenses you are making, you might put it in your balance sheet as R&D. as an asset, and they are the R&D costs. Or capex, like we took the steel plant example in the beginning, right? So that's a plant and machinery is a capex, right? So these are all different outflow items. Again, the beauty of the model that I'm going to show is all this you can define, right? There's no like if you go to a public cash flow, then you are bound by how your accountant wants to bucket it. Here the flexibility is the founder to actually put it in a way that you understand it and you want to monitor it, and your investor or your other stakeholders want to monitor it, right? So that is the flexibility you have. Any questions so far? Is this clear? Yeah, selling general and SG&A. Yes, thank you, Anya. So yeah, this is just some before some examples. So like so inflow, some best practices as well, right? So limit the inflow items to the right level. See, at the end of the day, look at what the context is. Of course, if you are dealing with your cash flow on a daily basis, you can go into any level of detail. But let's say your investor is looking at it, or let's say some other mentor or advisor is looking at it. Now you don't want to give like 100 line items to that person. So you need to limit your design of your cash flow should be very, very elegant, right? And just to the right level, so that you can do a lot of analysis. And you can, if you want to go to the detail, you have ways to go to the detail, but you don't necessarily need to put everything in one place, right? So design of a good cash flow is very important. So limit the inflow line items, and so is the outflow to the right level of detail. Typically, I say, because it's like typically revenue, and there are not like hundreds of revenue items, right? It's not like you have 100 SKUs. Your cash flow should have 100 line items. You bucket it then, right? So you put all consumer goods in one line item, or things like that. So like, I have tried to give that example here to give you the example. So it is not a real cash flow, but I'm telling you that, let's say you can have a product level line item. So if you have just 3 products, then let's say so if Santosh is selling software, so it's like sale of software, right? And he might be selling something else, then something else, right? But let's say you have a lot of SKUs, then you can have a category, right? So if say sale of let's say food-based products, or sale of ecology or whatever, environment products, something like that, right? So they are categories. Or you can also have region if you become sufficiently big. Like let's say Zomato might say, okay, what is my revenue from North region, or what is my revenue from South region? Now, the reason I am giving you all of these examples is this is your choice, how you want to best represent your summary of your business, right? These are all at a summary level. Of course, if I click on Zomato North, then I can go to Delhi, and then within Delhi I will go to saying, okay, sale from commission, or sale from some other uh, services or something like that, right? So then you can have further, the hierarchy of the way you want to represent it is all up to your assumption. Or it could be like a service fee, or it could be subscription fee, consultation fee. So these are all different line items, and you can represent it the best. Like I said, try to keep it like 4 to 8 line items, especially pre-funded Series A companies. Life is rather simple for you, right? So keep it simple in that sense. And decide on the revenue items based on your business model, like its product lines, categories, geographies, business units, etc., right? Other standard inflow line items are obviously loans, like I said, investments, grants, and other cash injection, which could be like you winning a prize, or somebody giving you a grant, or somebody other giving you a loan. So yeah, it can be any kind of injection that's possible. And then you also need to look at, be wary of how do you grow those assumptions. So growth can be like, you can have a periodic growth, like you have monthly growth rate. It could be organic growth based on what is seen in the market condition. It can be inorganic. Let's say if you spend on advertising, marketing, branding, it can be inorganic growth as well. And it can also be upsell. So you're already having a customer base, so you are bringing a new product line. So it can be on top of it. It can be expansionary. So you say you are in this geography, this is the revenue I'm making. So if I'm going to 10 other same geographies, then how much will I make, right? So all of these are reasons you can that's a good question. Actually, I need to get back on the OD. So see, in a way, it depends upon how you factor it. One way you can look at it is, you can treat it as a liability on your books, because as you so if you draw from it, definitely it is a cash receipt. Yeah, that is the way you put it, right? So you have a facility of an OD, which is there with your banks, which is an overdraft. And if you draw from it, then it's a liability on your books and it's the cash receipt on your assets. So the balance sheet is balanced, right? That's the answer to that. So yes, back to the revenue growth assumptions, and I'm going a little detail into this because this is what we will use to create our cash flow. Okay, so it could be simple growth based projections, saying every year this product will grow 5% month on month, or I will say, okay, from January next year, I will add a new incremental product line, like apart from giving let's say this software, I will give you this feature on top of it, right? Or you say, okay, I was only selling to Bangalore, now I'm selling to Tamil Nadu also, so or Chennai also, right? So that's an expansion. So I'll put a sales person there in the next 3 months, and from next 6 months I will start realizing revenue from that geography. Or new product itself, so I was selling software, now I'm selling some service, or selling the service layer of the software, let's say. Or new category itself, that I was selling let's say vehicles, now I'm selling battery, right? Or churn, so people are also leaving your product also, so how are you? So all of these are different variables that you need to, I try to make a laundry list here, but these are all different parameters you are playing around in creating your cash flow, right? And we will all use this to some extent as we do this. Next, outflow also is equally important. In fact, outflow is more important because early days you might have more outflow related expenses than inflows, which you might be still pre-revenue in some sense. So there's cash paid out. So this is the typical like two formats I just used in some of the examples that I've done. So for example, this can you tell me what kind of a company is this looking at the outflow? So there's some sales, there's product. So this is all salaries, right? Salaries of sales, product, tech, Marcom, program management, events, toolkits, content. Okay, good. Varun saying SaaS. Yeah, I can imagine this could be SaaS, but little more. It's not just doing SaaS, but doing many other things. Looks like it's also doing some program element, or it's creating content here, right? So based on the expenses, you can see what kind of a company it could be. Product based, good. So there's a product element and also a service element also looks like, based on what I can see. Okay, but this is the standard. So is this startup right? Maybe if I were the startup, I would not classify too many of these line items at the summary level. But again, if you think you need it at that level, it's good. Technology solutions, good guess. What do you think is this company? Cost of goods sold, labor costs, sales commission, very other infrastructure costs, management salaries, SG&A again, R&D costs, capex, manufacturing. Good, yeah.